Yeah, so that gap in the speeds, I love when you said like, so this is the first time where a sound money lost to a weak money, and it was really just because of convenience, right? Like gold lacked divisibility, it lacked portability, and so that led rise to all this financial abstraction. And it seems like over time that financial abstraction got even more and more opaque, more and more complex. Like I'd love to go into some of the negative consequences of the centralization and how when we trust a central bank, if you're an average user, what are you kind of giving up in terms of your privacy, in terms of your, risk of debasement that can maybe be solved by something like Bitcoin being able to close that gap? Because it seems like that gap between the settlement transaction speeds allowed for this whole banking sector to grow to a massive amount and to gain so much power. But now Bitcoin comes in and kind of throws a wrench into their whole plans. So what does an average user kind of lose when you have this centralized system? And then how can Bitcoin kind of help that?
Sure. In the past couple centuries, most technologies that made money more efficient came at the cost of more centralization. Basically, they introduced a further degree of centralization in order to add a degree of efficiency to the system. And so, if you go back long enough, people were trading physical gold and silver coins with each other. Then they graduate to banknotes and other types of paper instruments where they're still fairly private and they're sound and they're backed, but they rely on a counterparty to actually have the gold, or at least most of it. And then over time, that naturally results in problems where if the underlying is slower and people rarely want to withdraw it, the people managing those custodians and those banking arrangements are going to realize that. So they're going to say, well, if never any more than 40% of people want their gold back at a time, I can lend the other 60% out. And so they can start making more and more claims for the gold and silver than there actually is gold and silver. And the problem is that, back in that era, like the free banking era, if banks run into a problem, the claims collapse down towards the underlying gold and silver. And that kept happening enough that they said, okay, let's set up a central bank. All banks will store the reserves in the central bank. The central bank will hold the gold, and it has flexibility with the base layer to bail out banks when they need it. And you got to an environment where whenever the number of claims became too high relative to the monetary base, instead of the number of claims collapsing down towards the monetary base would expand to keep most of the claims money good. And so we've entered this structurally more inflationary monetary environment. And that has a number of consequences. One is we talked about earlier about the unit bias of contracts and wages. So in a disinflationary or deflationary environment, we have a very scarce, kind of slow growing or no growing money supply. The unit bias favors the contract holders and the wage earners, because you have a stable unit of account. Whereas if the money supply is constantly inflating and the unit of account is devaluing, it's the onus is generally on those who have to try to get wages increase just to keep up with inflation, let alone to compensate for their greater experience and productivity. So that's one factor. Another one is if you exchange gold and silver coins with people, or you exchange physical banknotes backed by gold and silver, and you can hold them for pretty long periods of time because you don't need interest because they're backed by gold and silver. They're fairly sound. But if you start to have a more inflationary monetary environment, thanks to central banking, it's unsafe to hold large amounts of banknotes because they're going to get inflated away if you're not earning interest to keep up. And so you're more inclined to put them in a bank and hold them as interest-bearing deposits. But that means now that the bank can see everything you do, and by extension, the bank's government can see everything you do. And then, so we've given up centralization. We've given up the unit of account to a more devaluation one. We've given up a lot of our privacy to kind of compensate us for the inflation that keeps happening. And then an additional thing is that by having a very flexible monetary base, it allows the easier picking of winners and choosers. So on one hand, whenever you have a government, it's always possible to pick winners and losers. But the more flexibility you have in the monetary base, the easier it is to pick winners and losers. And so, for example, during the COVID era, as an example, actually during 2008, for example, when the global financial crisis was happening, it was easier for central banks and governments to bail out the say top 25 largest banks than to bail out millions of homeowners. So they bailed out from this top down, and that's why you got a lot of populism, because they bailed out the rich people, they didn't bail out the middle class. And then during the whole kind of COVID lockdown period, they tried to bail out the middle class. They gave them stimulus checks, they gave them child care tax credits, things like that. But when you look at what happened in credit markets, they were able to unfreeze corporate bond markets a lot easier than they could unfreeze distributed bank lending. So large corporations got easier access to credit than small businesses did. And then in addition, when they tried to do the PPP loans, the vast majority of it ended up going to the top 20% of the population. There were entities like law firms that got $500,000 PPP loans that didn't need them, and all that turns into grants and just goes to the bottom line of like the top three people that run it. And so there's multiple kind of privacy shortcomings, wealth concentration shortcomings that all start to accrue when you enter a more flexible and inflationary monetary regime.
So you brought up how like inflationary policies can lead to more concentration and enhance the power of the banks, which can allow them to surveil, which is obviously a problem. Now people would turn around and be like, wait, deflation's bad. But I think you did a great job in the book kind of explaining why, hey, that's not really the case. Like deflation can be good. And I think if somebody's watching this and maybe went to a business school, they'd be like, wow, I've never heard that before. Deflation is good. And so maybe we can just break down why you think deflation is good or can be good.
So I think we can look at it both theory and practice. So, I mean, in the second half of the 19th century United States, that was a rather deflationary environment. And that's when the United States became superpower. That was when some of our major innovations were discovered: electricity, engines, all these kind of major inventions, the automobile, early flight. A lot of this happened in the late 19th century, early 20th century during a hard money, rather deflationary type of environment. So obviously it's not directly antagonist to economic growth. I think the more theoretical way to think about it is that in general, what human progress is that we get more productive at making most types of goods and services. Now that doesn't apply to certain things like waterfront property or Van Gogh paintings, but the most things in the world we get more productive over time at making. Sometimes we get slightly more productive, like we get better building materials, or we get more efficient things like that. Other times there are other areas that are super productivity growing, like Moore's law, electronics, software, very cheap goods that we're way better at mass producing now with industrialization. So there are certain kind of very deflationary categories and other mildly deflationary categories. And what central banking basically says is, no, deflation's bad. Even though humans get productive every year and things should get slightly cheaper on average every year, we have to make sure they go up in price every year. That's kind of the core of central banking and the positive inflation target. And the reason they have that and the reason that people think deflation's a bad thing is because during this century and a half of monetary abstraction, between transaction speeds and settlement speeds in this period of abstraction and monetary devaluation, it's expanded the role of credit. So if you have a very hard unit of account, people generally don't want to borrow for the long term. But if you have a constantly devaluing unit of account, it encourages very large amounts of credit and debt to build up in the system. And the problem is if you get up to, if you look at private and public sector together, if you start to get up to 200, 300% debt to GDP, you can't have deflation anymore because you have so much debt relative to the level of the economy that if you start to get prices going down or you get the economy seized up in every way, all that debt starts to cascade, and it's like a game of musical chairs. Whereas if you have a very equity-based system with rather low amounts of productive credit, rather than this kind of everything built on credit, deflation doesn't really hurt that much. In addition, inflation, again, it puts the unit bias against the worker. And you see that remarkably in developing countries, where if they're dealing with 20% inflation and they're not getting 20% raises every year, they might probably not even getting 10% raises every year, their global purchasing power keeps being devalued. Whereas the wealthy people in the country, they're generally, they're fine with their offshore bank accounts and they're, they might be in the export business, so that they might be earning dollars, for example. They're parking their money elsewhere. They're earning their money elsewhere. Whereas the average person is earning and saving in the local currency and constantly getting devalued. And you see that in developed countries to a less extreme degree, where, if you have a 2% average inflation target, if you have 7% annual money supply growth, which is what we've had in the developed world, the wage earner has to constantly try to keep up with that. and it's like a treadmill that's going very quickly. It's very hard to keep up. Whereas if you're an asset holder, if you have access to low interest rate credit, you're doing very well. So I think the system's been designed such that we have deflation as a narrative that's a bad thing because of how indebted the system is. And that part's true. If you have a highly indebted system, you can't have deflation. Whereas if you have a more equity hard money system, deflation's fine and even desirable. And one case where this shows up is, people will say you can't have deflation because people will endlessly defer consumption. If things are going to be cheaper next year, they won't want to consume this year. But we don't see that in electronics. We don't see, the fact that a 1 terabyte drive gets a little bit cheaper every 2 years. We don't see people saying, well, I'm not going to buy terabyte drives until the next 2 years. No, we need computers now. We need electronics now. We want to get the reasonably working equipment now, and we upgrade over time as we need it. And so rather than waiting memory to get cheaper, we just use more memory as it gets cheaper. And so you don't see deflation in technology slowing down technology as a industrial sector. If anything, that's been the best performing sector for decades on average. And yet economists make us think that it's supposed to happen to every other sector, that we're just going to endlessly defer purchases if prices gradually go down over time, where that's just not the case in practice.